If you are a senior living in the United Kingdom and you have been watching the property market with a mixture of hope and anxiety, wondering whether your retirement plans are secure or whether the value of your home is about to change dramatically, then you absolutely need to stay with me for the next few minutes, because what I am about to share with you could genuinely change how you think about your financial future in these uncertain times. The British property market is currently sitting on what I can only describe as a knife edge, and the decisions being made right now by the Bank of England, by major lenders, and by the government itself will have profound consequences for every single homeowner and every person who relies on property wealth for their retirement security. I have been following this story closely, and I want to break it down for you in plain English so you understand exactly what is happening and what it might mean for your situation. Let me take you back to 2022, when the chaos of the mini-budget sent mortgage rates soaring past 6% and essentially froze the entire housing market. Many of you will remember that period vividly because it caused genuine distress for families across the country. Fast forward to today, and we have seen rates falling steadily through 2024 and into 2026, which on the surface sounds like wonderful news. The major high street lenders, including HSBC, Nationwide, and Barclays, have been slashing their rates repeatedly in what amounts to an aggressive price war. Some specialist lenders are now offering rates as low as 3.4% for borrowers who can put down a 40% deposit, which represents a massive shift from where we were just a couple of years ago. Now here is where it gets really interesting and why you need to pay attention. When you look at the numbers, the difference is absolutely staggering. Someone borrowing £300,000 at 6% would be paying approximately £2,000 every single month. Take that same loan at 4% and suddenly the monthly payment drops to around £1,400. That is a saving of £600 every month, which works out to £7,200 saved every single year. For seniors who are helping adult children get onto the property ladder, or who are considering equity release, or who are thinking about downsizing, these numbers matter enormously. The financial markets are currently betting that the Bank of England base rate will fall to approximately 3.25% by the end of 2026. This expectation has been baked into everything from mortgage rates to property valuations to the advice that estate agents are giving to buyers and sellers. Developers are planning new projects based on the assumption that demand will remain strong. Individual buyers and institutional investors alike are making decisions based on this anticipated trajectory of falling rates. But here is the critical issue that I really want you to understand, because it could affect your retirement security directly. There is a growing gap between what the markets expect and what the Bank of England is actually signaling. The bank has been far less confident about continued rate cuts than many market participants seem to believe. If the bank disappoints these expectations, the entire property rally that we are currently witnessing could collapse almost overnight. This is not scaremongering. This is simply the reality of how interconnected our financial system has become. The Bank of England's ability to cut rates depends entirely on keeping inflation under control, and inflation is proving to be far more stubborn than the experts predicted. While headline inflation has come down significantly from those peak levels above 10% that we saw in 2022, the core inflation measure, which strips out volatile food and energy prices, remains elevated at around 3.4%, which is well above the bank's 2% target. Even more concerning is service sector inflation, which is sitting at 5% as of January 2026, and this reflects wage growth feeding through into prices for everything from haircuts to restaurant meals to professional services. For those of you who remember the inflation of the 1970s and early 1980s, you know exactly how damaging sustained price rises can be to retirement savings and fixed incomes. The Bank of England has repeatedly stated that they focus primarily on core inflation and service sector inflation when making their rate decisions, and both of these measures suggest that the fight against inflation is far from won. Average wage growth across the United Kingdom economy is running at approximately 5.2% annually. While working people quite rightly celebrate pay increases after years of real terms pay cuts, this wage growth creates inflation pressure that limits the bank's ability to cut rates further without risking a return to higher inflation. The Labour government's budget has added another layer of complexity to this situation. The significant public spending increases, including substantial public sector wage increases and major infrastructure investment programs, could add roughly half a percentage point to inflation over the next couple of years, according to the Office for Budget Responsibility. This creates what economists call a policy conflict. The government wants to stimulate growth through spending, while the bank wants to control inflation through maintaining higher rates. Something has to give, and ordinary people like us often end up caught in the middle. We must also consider what is happening globally, because the Bank of England does not operate in isolation. The American Federal Reserve has signalled that it intends to maintain higher rates for longer than previously expected because US inflation has also proven persistent. If the Bank of England cuts rates aggressively while the Federal Reserve holds steady, the pound weakens significantly against the dollar. A weaker pound makes imports more expensive, and since Britain imports substantial quantities of energy, food, and manufactured goods priced in dollars, currency weakness translates directly into higher prices at the supermarket and the petrol station. Global trade policy has become increasingly unpredictable, with major economies implementing tariffs and trade restrictions that increase costs throughout supply chains. The United Kingdom's post-Brexit trade arrangements remain complex with ongoing negotiations, affecting everything from agricultural imports to financial services. Energy prices remain volatile due to geopolitical tensions, and while they have moderated from peak levels, they could spike suddenly at any time. All of these factors limit the Bank of England's confidence in cutting rates. So what happens if the expected rate cuts do not materialise? The consequences for the property market will be severe and immediate. The current buyer demand is based on the assumption that borrowing costs will keep falling. Many buyers are stretching themselves to maximum affordability based on current rates, betting that refinancing in 2 or 5 years will be cheaper. If rates remain elevated or actually increase, these buyers face what the industry calls payment shock when their fixed terms expire. Someone who can barely afford payments at 4% simply cannot afford the same property at 6%, and this creates forced selling as overstretched buyers cannot refinance or maintain their payments. We saw this exact pattern unfold in 2022 when rates spiked following the mini-budget. Transaction volumes collapsed by nearly 30% within months. Sales that were already proceeding fell through as buyers lost their mortgage offers or could no longer afford the properties they had agreed to purchase. Estate agents reported chains collapsing throughout the country, and buyers who had already sold their existing properties found themselves living in temporary accommodation because their onward purchases fell through. The current rally is creating the same fragile conditions. For seniors in particular, this matters for several reasons. If you are considering downsizing to release equity for your retirement, market volatility could significantly affect the value you can achieve. If you are helping children or grandchildren get onto the property ladder, you need to understand the risks they might be taking on. If you hold property as part of your retirement wealth, the value of that asset is not as stable as it might appear. And if you are considering any form of equity release, the terms available to you depend heavily on interest rate expectations. Buy-to-let investors, some of whom are retirees supplementing their pension income, face particularly severe pressure right now. Mortgage rates for investment properties sit approximately 1 to 2 percentage points above residential rates, meaning many buy-to-let mortgages currently carry rates of 6% or higher. Rental income growth has not kept pace with mortgage cost increases, and many landlords are operating at negative cash flow, effectively subsidising their rental properties from other income. If rates remain elevated, more landlords will exit the market, but they cannot sell quickly because buyer demand is constrained by the same high rates affecting their refinancing options. Beneath all the rate speculation and market psychology lies a fundamental problem that affects everyone. The United Kingdom simply builds far too few homes relative to population growth and household formation. We add approximately 220,000 new homes annually, but need at least 300,000 to keep pace with demand. This shortfall has accumulated for decades, creating a structural supply deficit that no amount of monetary policy manipulation can solve. Until housing supply increases substantially, UK housing will remain structurally unaffordable for most working people, and that affects the entire economy, including the retirement prospects of everyone who lives here. The current market dynamic creates clear winners and losers depending on timing and circumstances. Anyone who bought property in the past 6 months based on current rates and expectations of continued falls faces significant risk if those rate cuts do not materialize. Buyers with substantial cash who are not dependent on mortgage financing can potentially capitalize on market volatility if prices fall due to affordability constraints affecting mortgaged buyers. Homeowners with significant equity and low fixed rates are insulated from most risks and can wait out market volatility, but those who need to move due to job changes, family circumstances, or health reasons face difficult markets regardless of broader trends. I want to be clear with you because I believe in giving you honest information rather than false hope. UK house prices are indeed likely to rise in the near term. Falling mortgage rates have transformed affordability and unleashed pent-up demand from buyers who were priced out for 2 years. Estate agents will be busy through spring 2026. Prices will rise in most regions, and headlines will celebrate the property market recovery. But the entire surge is built on assumptions about future rate cuts that are far from guaranteed if those expected rate cuts do not materialize, or worse, if rates must rise again to combat inflation. This property rally does not just slow, it reverses sharply, potentially trapping buyers who borrowed maximum amounts based on optimistic assumptions. The UK housing market in 2026 sits at a dangerous inflection point. Prices may explode upward if conditions align perfectly, or they may collapse if rate expectations prove wrong. Anyone entering this market, whether buying, selling, or releasing equity, must understand they are making a highly leveraged bet on interest rate policy over which they have absolutely no control. For seniors planning their retirement around property wealth, this uncertainty demands careful consideration and ideally professional financial advice before making any major decisions. If you found this information helpful and you want to stay informed about what these property market developments mean for your retirement security, please subscribe to my channel and hit that notification bell so you never miss an update. I am committed to bringing you honest, straightforward analysis of the UK property market without the hype or the scaremongering you see elsewhere. Together, we can navigate these uncertain times and make better decisions for our financial futures. Thank you for watching, and I will see you in the next video.